Welcome to Catalysts. I'm Brad Smith. We're about 30 minutes into the U.S. trading day. Let's get to the three catalysts that we're watching this hour. First up, risk-off sentiment grips investors, but can the market momentum continue? We'll discuss that. Plus, the Senate making big changes to President Trump's mega bill. We break down what you need to know there. And we bring you the takeaways from our sit-down conversation with ex-CEO Linda Yaccarino. All that and much more coming up on Catalysts. Half an hour into the start of U.S. trading, let's get to it. Check of the markets here first as we're taking a look at the U.S. major averages. We are down across the board fractionally as that may be. We're seeing declines of about 0.2% for the Dow Jones Industrial Average and the S&P 500 there. And then the NASDAQ Composite down by about 0.4%. We'll round that off too. Also flipping on over to the bond market here, taking a look at the 5, the 10, and the 30-year. Those also moving lower here today. Fractional percentage moves to the downside there. And also honing in on the state of treasuries a little further here as yields are edging lower as the Fed is expected to remain on pause for some time. I'm going to bring in my guest contributor for the hour. We've got Peter Chur, who is the Academy Securities Head of Macro Strategy. Great to have you here on set with us today.
Great to be here. Thanks.
So let's dive into where we just kicked off today's show, which is yields and what the expectations are that the market is clearly reading through for the FOMC and how that's anticipated to also impact the 5, the 10, and the 30 year as we were just showing.
Yeah, the market seems to be pricing in that the Fed's going to be fairly cautious about cutting rates. I think the first cut is actually not priced until September, and there's only 1.75 cuts priced in for this year. I think that's a bit low. I think we've actually made progress on inflation. I think at pause rates and tariffs, for whatever we want to call that, call it 10, 12%, I think the inflation's going to be manageable, and I think the job market's deteriorating. So I think the Fed, if they do their job right, should be putting July on the table tomorrow.
We continue to hear that we could potentially see kind of this long-run tariff rate that many investment firms, and we even saw this come through the B of A fund manager survey here today, that it's expected that it'll be in this range of about 13% according to the fund manager survey, long run. What would that do to the timeline for policy for the Fed if there was a mitigated impact compared to what was anticipated at the worst of the onset?
And I think that's a great question. I think when Powell was reluctant to cut, when the economy was looking, sketchy, when stocks were plummeting, it's because the tariff uncertainty was so high. Yeah. Tariff uncertainty is greatly reduced, and I think if you look at this 10 to 13%, my assumption has been exporters will eat some of it, call it 3 to 5%. Ultimately, importers will eat a little bit into margins. They will ultimately try and price a lot of that into the consumer, but it takes time, right? People have 6-month annual contracts. So I think we will see this kind of 2% inflation, maybe 3%, maybe 1.5% going through. The economy is going to slow down a little bit. We've seen some pressures in the economy. I think the jobs data was a little bit overstated. I don't like how it's been, the only really good data point was the establishment headline that we all look at. If you look beyond that, everything else is weak. So I think the Fed's going to be in a pretty good position to cut.
You mentioned a great point, which perhaps doesn't get enough attention. These contracts are not just like day in, day out, or quarter in, quarter out, like we're making these purchases and now we have to adjust the prices that we're passing through to consumers. No, businesses have longer term contracts, but then in their forecasting, they try to anticipate to the best ability possible what the incurred expense might be if the worst case scenario is more prolonged. When that is not the case and that's taken off the table, how should that also be factored into the valuations of these companies that are saying there's macro uncertainty, but now we're seeing that abated to a certain extent a little bit?
Yeah, and I think that's a great question. I do think there will be some margin pressure. So I think we have to watch for margin pressure because of that inability to pass price hikes on fairly quickly. So watch for that. I think the market can ignore that a little bit. What I really want to start watching, though, for the big global companies is, do they see any pressure on foreign sales? One of my views has been that the chaos, for lack of a better word, that the U.S. has done in trade negotiations, et cetera, has diminished the American brand. And so what I really want to see is, do foreigners buy American brands at the same pace they were? And that's important. 40% of the S&P 500 earnings come from overseas. So if there's a slowdown there, that to me is more meaningful and harder to correct than some temporary, margin issues.
I was going to save this for later on in the show, but since you brought that up, one of the top questions that we've been talking about in our morning meetings is is really who are the biggest winners and losers brand-wise that could also play into an investment strategy for people who are watching when it comes to a shift in sentiment among U.S. brands that are operating in different regions and trying to make sure that they kind of maintain their own footprint that they've been able to bring to life.
Yeah, one thing I find very interesting, if you watch TV here, you see Mercedes, you see BMW, and their commercials are angling, hey, we're made here, we're an American car company, or our cars are made in America, we employ American people. So I presume you're seeing some of that go on elsewhere, right? Because these global companies are truly global in nature. And I think that's the one thing I keep coming back to, especially as we kind of fight with China. The concept of China Inc. is real, right? China, the government, Chinese the corporations are one and the same. I think the issue that we face here is the U.S. government and U.S. corporations are not one and the same, right? They are global entities. They have constituents across the globe. So I assume they're all trying to figure out how can they resolve this kind of brand damage that's maybe been done at a national level to keep their brand sales going. And I don't think we're going to see much this quarter. Maybe we start seeing it, but that'll be the second and third quarter data coming through.
All right, we've got much more to discuss. Stick around here with us, Peter. We are going to switch gears here as stocks right now, they're moving to the downside for the U.S. major averages as investors look to navigate escalating conflict in the Middle East, weak retail sales data, and the Fed meeting kicking off today. Despite the uncertainty, the Bank of America Global Fund Manager survey shows investor sentiment is returning to pre-Liberation Day Goldilocks bull levels. Joining me now, we've got Bryant Van Cronkite, who is the All-Spring Global Investments Senior Portfolio Manager. You are still finding opportunities right now. Where most notably are you seeing some resilience in the market?
Yeah, it's going to be with you today. We are finding opportunities, but we need to have a balanced portfolio. The market has chosen to be optimistic on the body of evidence we've seen so far, which I think is justified. The hard data, like unemployment rates, are staying relatively benign, but it does leave the market susceptible to a pullback in the event some of these bigger issues that are looming, like trade negotiations, like hot wars in Europe and in the Middle East, potentially ramp up. And so we want to have a balanced portfolio playing offense, defense, and offense within defense across several different sectors today.
And so within that, as you're thinking about the prioritization of each of these matters, which do you think investors should be ranking the highest to keep their sights on?
I think, again, right now, you don't want to over-prioritize anything given the risk embedded in the market. So for now, I want to have offense with companies that haven't quite participated in this rally. And for example, a great place to look right now is in the housing-related companies, whether it's the builders or building products companies. The home affordability issues have put massive downward pressure on starts and have put pressure on restoration of houses, and as a result, those companies haven't participated. So D.R. Horton is a great example of one of the largest U.S. home builders that we believe has an asset base that's can create much better earnings power in the future as interest rates and mortgage rates fall and housing starts to flare back up. And so on the offensive bucket, D.R. Horton is a great place to look today.
You know, when you think about what has really driven the market over the past 2 years, it's been so much fervor and hype around generative AI. Where does that sit amid some of the confluence of issues that the markets are wading through right now?
It's certainly a challenge for a lot of us to figure out which companies are most exposed to the risk of generative AI or AI in general. But as we talk to companies and talk to the CEOs and CFOs, almost all of them believe they are net winners as AI is rolled out. Some of them through revenue generation and new models for creating top line growth. But most of the companies believe that they will be able to use AI as a general tool to help reduce the cost to serve their customers, whether it's through product development or through expense savings. And as a result, they think they'll be winners. So right now, the jury is still out. We continue to talk to companies about the opportunity set here, but for now, we don't have that as a theme we're using, but we are watching our companies invest behind that opportunity.
How much are we able to look to the biggest tech companies still as a guiding light, if you will, or a North Star for how much risk appetite there still is in the market? Because we used to look to some of those tech names and say, okay, if they're getting a ton of flows towards them, then the risk on appetite is there. But when you've got it so overcrowded already, it seems like it's just such a staple at that point that you have to look to other areas to really assess how much risk investors are willing to take on.
I think it's a mistake to continue to look at that group of companies as one group. The individual companies are having very different strategies, very different investment philosophies, and different exposures to the broad economy. So we are now taking that group apart and saying, what is this company doing to uniquely drive their destiny? I think you're right. I think a lot of capital flows into the Mag 7, into the large cap tech to hide. There's very visible growth there. There's defensive cash flow characteristics. The balance sheets are in phenomenal shape. And so a lot of money is hiding there. But there are pockets of opportunity that we think you can use to play offense as well. And for example, we think a lot of the risk embedded in Alphabet right now is misplaced. We believe the investments they're making are actually going to allow them to maintain their superiority in search. We believe they will create new revenue models. And we believe through the use of AI as well as other tools, they will find meaningful efficiencies to drive margins higher and support their business. So we put Alphabet in a world of its own, thinking that they can not only provide defense, but also offense right now.
Okay, for the 60-40ers out there, I want to know how you're looking through some of the fixed income elements of where people's portfolios should be navigating this current environment right now, especially as we're kicking off today's two-day FOMC meeting.
Yeah, certainly rates have a meaningful impact on equity prices overall, and rates are quite stable right now, which allows companies to ultimately refinance debt at what they think are attractive prices today, using that capital to reinvest back in their business. We don't anticipate rates shocking us in any material way. We don't expect the Fed to cut rates anytime soon. And so what we're looking for right now are companies that are using their capital, using their cost of capital in a wise way to drive future investments. One of the things we want them to do right now is maintain flexibility. As rates are stable and volatility increases in equity markets, we want flexibility to use our capital in a plethora of ways to create meaningful value. And so we like the idea of having capital available for acquisitions, we like it available for buybacks, we like it available for organic investments, and we're fading away from dividends as a use of capital right now. We believe that restriction is a handcuff on the flexibility of your cash flow and balance sheet. And so rates today are stable, they're benign. We don't view them as an issue. We view them as an opportunity for housing potentially in the future, though.
Bryant, good to have you back with us. Thanks so much for taking the time this morning.
Pleasure.
Let's check in. Shares of pharma stocks as the Trump administration weighs a crackdown on pharma ads, they are in decline. According to Bloomberg, this news, and shares of Pfizer and AbbVie, they are falling to session lows amid the report. The Trump administration is discussing policies that would make it harder and more expensive for pharmaceutical companies to advertise directly to patients in a move that could disrupt more than $10 billion in annual ad spending. Although the U.S. is the only place besides New Zealand where pharma companies can directly advertise, banning pharma ads outright could make the administration vulnerable to lawsuits. So it's instead focusing on cutting down on the practice by adding legal and financial hurdles, according to sources cited by Bloomberg. All your markets action ahead. Stay tuned. You're watching Catalyst. Time now for today's trending tickers. We're watching Jabil, JetBlue, and JP Morgan Chase. First up, Jabil, topping third quarter expectations and raising its outlook for the full year. The manufacturing services provider benefiting from AI-driven demand. The company also announcing a $500 million investment in U.S. manufacturing for AI and cloud infrastructure. Next up, JetBlue, implementing more cost-cutting measures as weaker travel demand weighs on profitability. According to an internal memo sent to staff, the airline plans to cut more flights, reducing off-peak flying and unprofitable routes. The carrier will also park some Airbus jets that were slated to be restyled and combine some leadership roles. In the memo, the CEO said it's now unlikely the company will reach break-even operating margin this year. And finally, JP Morgan Chase announcing changes to its Sapphire Reserve credit card. The bank hiking the card's fee by $245, bringing the annual fee to $795 and redesigning its perks. This is the latest move by JP Morgan to stand out in the ultra-competitive premium credit card landscape. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Coming up, the Senate's draft of the GOP tax bill makes some crucial changes. We're breaking those down next. Senate Republicans unveiled their draft of the GOP tax bill with some crucial changes from the House version, including a placeholder for the hotly debated SALT cap. Yahoo Finance Washington correspondent Ben Werschkul has more on the details here. Break this one down for us, Ben.
Yeah, Brad. So the Senate released this version last night, 549 pages long, and two pieces jumped out immediately as clearly the most politically contentious. You mentioned the SALT one. So this was a reduction in the SALT credit. The House passed a $40,000 credit. The Senate version does make it permanent, but it's the current $10,000 credit. The SALT caucus has already said it's going to be 40,000 or we're going to sink the bill. So that's going to clearly be a point of a lot of conversation in the weeks ahead. The second is these Medicare cuts. This bill surprised a lot of healthcare experts by having kind of more aggressive measures on Medicaid's tax structure. Basically, this would hit rural hospitals, especially, or one that come up a lot. This would hit them. That could hit them hard, and already has some opponents, even among Senate Republicans, there on the Medicaid side of this. So that's going to be another point. There's also a lot in here, kind of a little bit below the radar, on business world provisions that I think will be a focus to business owners. The big one here is a Senate priority from the beginning, basically since they got the keys to this bill, to make some key business tax deductions permanent. This is things like R&D expensing, new factory construction, interest expenses. The House version had versions of this, but the Senate version does make it permanent. This was a priority for them, but it will increase the price tag. There is a key kind of like sort of semi-loss for business interest in this bill, which is this idea of a revenge tax, which was introduced in the House version. It allows the president or any administration to levy taxes in response to foreign taxes that they don't like. The digital service taxes in Europe are a big focus here for President Trump. That remains in the bill. It's been pared down a little bit in return to these interests, but there's a lot of fears that if that goes through in some form, it could lower multinationals' interest in investing in the U.S. if you have a foot in both countries and you're worried about these revenge taxes. So a lot of pieces here. The goal here is to get this through among Republicans, is to get this through by July 4th. There's a lot of, as I laid out all these issues, it's a heavy lift for certain. But they're definitely going to be talking about this a lot in the coming weeks.
Yeah, Ben, the White House also has contradicted economists on how much the bill will cost. So how are they arriving at such different numbers here?
Mm-hmm. Yeah, so we don't have a score yet or a analysis of the Senate bill. It just came out. They have to go through that line by line, but we do have one for the House version. And the consensus amongst economists is that there's about a $3 trillion over the next decade price tag associated with this. This is because, as you can see on the screen there, those tax cuts will cost a lot of money, and the White House is basically offering a whole different picture of this. It's sort of a three-step process which they change here. First one is to sort of eliminate those tax cuts entirely. That's a long-standing Republican argument, belied a bit by history and previous tax cuts, that basically tax cuts are free, that if you reduce taxes, the revenue increases by the same amount, so it's free. That's their first way to change this. The second part is to offer really aggressive measures of growth. We're talking 3% growth, not just in the next 2 years, but every year over the coming decade. That's a really aggressive growth that the White House says they're confident will happen, but others are a lot more skeptical. So if you have a lot more growth there, that adds another $4 trillion onto their price tag. And then the third piece here is adding in tariffs. There is a CBO report from the Congressional Budget Office about tariffs potentially bringing in $2.8 trillion over the coming decade. But that means the tariffs have to stay exactly as they are, both in the coming years, as well as after Trump is scheduled to leave office. So that's created an $11 trillion price difference between kind of what economists say and what the White House says. And the expectation for the Senate bill is that it's not going to be a huge difference in price. There's some things that increase the cost, some that'll lower it, but we're still talking a multi-trillion dollar price tag. So we're still talking a big gap between what the White House is going to be saying over the next month and what economists and even some Republican fiscal hawks are going to say over the next month.
All right, much to continue to track over that period of time. Ben, thanks so much for breaking this down for us.
Sure thing.
Still with me, we've got Peter Chur of Academy Securities here, and you were listening in a moment ago here. I would love to get your read in on the tax bill as it stands right now. Of course, we're still waiting to see what the estimations around the long-term cost of this will be, but you've already had some key profile figures, even as this was making its way to the Senate, chime in on the costs and kind of on two different ranges of the spectrum. You've got Elon Musk saying it would be too expensive long run, and then you've also got JP Morgan's Jamie Dimon that had said it was going to stabilize things, but it could be more costly down the line as well here.
Yeah, and I think we have to get it through. And yes, I'm a little bit worried about the deficit, but the one thing that we have to be cautious of, most of this isn't actually tax cuts, right? The tax extensions don't really behave like tax cuts, right? So you and I aren't behaving as though this tax extension is going to go down. So if we lose the tax extensions, I think that really hurts the economy. So they have to push that through. I will give some benefit to the doubt that tariffs might do something, that maybe maybe they do something to offset that. But I think we have to get this through. And yes, people get scared. Oh, it's $3 trillion over 10 years. Well, guess what? That's like 30 billion, $300 billion a year. It's manageable. Sure. I don't think we get it all. I think we need to get this through, and then we can focus on it, get back to some of the things Doge was trying to do, root out, where there's waste, where there's inefficiencies. But at the very least, I think the tax extensions have to go through. If not, we are going to see a massive slowdown in the economy.
And so with that in mind, where are the areas, if we did see a resurgence in the prioritization of some of the efforts that Doge was putting forward, what type of economic impact would that have, especially as it would need to be then again factored in by businesses who rely on some of these government contracts, as well as just the general state of the employment situation as well?
Yeah, so I think certainly DC would continue to be hit. I think the defense industry would have to look, okay, how does this impact us? Across the board, one of the things a couple of members of our geopolitical intelligence group have been talking is trying to combine a little bit better the money that was going to USAID with the State Department. Because I think, one, it might be more effectively used. And one of the issues I think we face globally is when we try and address how much we're doing for countries, it's very haphazard. You have USAID doing something, you have the State Department doing something, then we have massive amounts of investment from US corporations, and I don't think we've ever tried to harness this and say, hey, South Africa, yes, China's giving you money for building your roads. This is how much money is coming to you from the US. So I think there's actually ways we could make it more efficient and get more bang for the buck and more results from that money. So I think there'll be some negatives. I think if this is framed right, though, we can make up for that.
All right, a lot to track here, and thank you so much for weighing in on this as well here. Peter's going to stick with us. We do have another major story that we're tracking here this hour. Just days ahead of the deadline for ByteDance to divest from TikTok or see the app banned in the U.S. President Trump says he's open to extending the deadline yet again here. The president telling reporters he probably will extend the deadline if Chinese President Xi agrees. Speaking with Yahoo Finance executive editor Brian Sozzi today at Cannes Lions, Linda Yaccarino, ex-CEO, voiced support for the measure.
We don't believe any social media platform should be banned. We don't think it's good for the ecosystem. And look at us, protecting free speech around the world. And we hope we hope that they'll work things out and it'll be part of the ecosystem.
Joining me now with more, we've got Yahoo Finance tech editor Dan Howley. So what would the extension mean for TikTok?
Basically that they get yet another last-minute reprieve. They originally went offline in January during the transition from the Biden to Trump administration. At that point, Biden had basically gone hands-off with TikTok. Trump was able to extend that deadline until April. That deadline came and went. He then extended the deal timeline again. And now he's doing it a third time because they haven't been able to get a deal together with who would purchase the stake in TikTok as ByteDance divests from it. That's the key thing, is that ByteDance, a Chinese-owned company, divests TikTok itself. And whether or not China will sign off on that, that's also a major part of that. Obviously, Brad, you pointing out that Trump had said he believes that President Xi would go ahead and do that, but that still remains up in the air. A lot of this seems to be tied to the ongoing trade negotiations. There were prior reports that President Xi was open to that kind of deal, but then once those tariffs came out, said that's kind of off the table now until we figured this out. So really, this is going to continue to be, I think, a back and forth. We'll see how many times this can be extended. I think that's also another question that a lot of people are asking, is how long can this possibly get kicked down the road? At this point, it seems as though it can just keep on going every few months. But really, I think at a certain point, there needs to be some kind of agreement as to whether or not someone takes a stake in TikTok. There have been plenty of names bandied about: Elon Musk, Larry Ellison, Mr. Beast for some reason. And so these are all kind of the questions that we're wondering. Still, 170 million users in the US. It's nothing to sneeze at, obviously. TikTok, huge social media company. I don't think Linda Yaccarino, though, would be truly upset if TikTok went offline. That just means less competition. Same thing with Mark Zuckerberg and Meta.
Yeah, perhaps would be more alarmed with the precedent that it might set,
Yes.
but I understand, of course, as we do know that X and Elon Musk have had a cozier relationship to the Trump administration than TikTok over time here. We'll continue to watch that. Dan, thanks so much for breaking this down. Well, we just heard thoughts on TikTok from ex-CEO Linda Yaccarino, but we discussed an array of topics with the head of the social platform. Take a listen to what she had to tell us.
eMarketer recently put out a report suggesting that your global ad revenue would rise 16.5% a year. That's a pretty good number. If it's
I didn't hear the number.
eMarketers.
Oh, no, they said 16%?
16.5%.
Okay.
What do you think about that growth rate for this year? Is that trending, are you trending above that? And what is your outlook for ad revenue for X?
I think they're being conservative. And what I would say is that the growth is consistent. The growth is driven by an extraordinary expansion of capabilities that is driving growth on the platform. And then again, advertisers follow eyeballs. But you also have to think about advertising is just a piece of their revenue at the company. You have three pieces of revenue. You have advertising, you have our API or data developer platform, and you have premium subscriptions. And then soon you will have X money on the platform. So I'm assuming that eMarketer number is probably a prediction at the end of last year of 425, and it probably was just looking at ad revenue, which is also growing at an extraordinary pace.
Will ad revenue this year for X be higher than pre-acquisition?
It's really hard to imagine the growth of the revenue at X and predict it into the future, right? And that's what we're talking about, is just we're talking about a different company. So really super exciting, big expansion of our partner base, and maybe you invite me back on your show at the end of the year and we could talk about how we busted through all those numbers.
I'm saving this. I am going to actually invite you back on the show. Is X profitable? Does it make money?
X in such a really good position, and actually when you look at our recent acquisition that our younger sister company XAI acquired X, imagine the growth and extraordinary meaning of the world's most powerful AI company coming together uniquely with a media platform. You could just, an overused analogy for our new company is the trajectory of a rocket ship, and I would say that that's pretty accurate.
Sounds like profits. I mean, the valuation.
Sounds like we're having a great year.
Okay, all right, that's fair. How will XAI be integrated into that X business? Like, what should people expect?
Well, XAI is already having a profound impact on the company. If you think about it, XAI, one of the world's fastest growing, definitely smartest AI company. So imagine the lure to the greatest talent in the world at XAI, right? Most powerful AI models, because it's driven by the most powerful amount of compute in the world, driven by the most powerful computer known as Colossus, stood up in only 122 days out of Memphis, Tennessee, right? You know that, right? So you think about that, and then you take X, right? So a massive social media platform with nearly 600 million monthly active users that uniquely have that real-time conversation and data. You bring those two companies together, and there's no surrogate for that. There's no company like that. So Grok, which is our model out of XAI, is having profound impact on the platform and then already working hard at tremendous product improvements like powering our timeline. So you're a big user on the platform. Power user, thank you for that. How great has your timeline and your For You feed gotten? So Grok is already having a great impact on your content recommendation, content moderation, and search on the platform.
Very interesting moment here in social media. We're coming up against the June 19th deadline for the TikTok ban. Do you think TikTok should be banned?
We don't believe any social media platform should be banned. I don't think it's good for the ecosystem. And look at us, protecting free speech around the world. And we hope we hope that they'll work things out and it'll be part of the ecosystem.
But if they don't exist, that's a big tailwind for X, no?
Of course it would be beneficial, but my answer remains the same. We don't think any platform being banned is good for the ecosystem.
You mentioned the push or the focus now in bringing that vision to life on making X the super app. How many subscribers do you have on the platform, and how much revenue do you bring in from them?
I already told you that the revenue breakdown on the company is growing extraordinarily. The subscriber growth is growing double digits every quarter, and the impact of Grok and Grok's improvement is really accelerating that growth, so we're super excited. It's why the success of creators coming to the platform. Khloe Kardashian. I have thrown out 2 or 3 models of what we think the ceiling should be on the performance of the Khloe in Wonderland podcast. Also, I would say that success has led to the announcements that I'll be doing a lot of talks on this week with, you may have heard of Serena and Venus Williams.
I have.
That'll be bringing their video podcast to the platform later in the summer. So super excited about that global icons, influencers, brand ambassadors coming to the platform because they know that if you want to be in the current conversation with the generation that's going to lead your career to the future, you got to be on X. You got to be in that real-time culture conversation because moments that matter most drop on the platform. That's where it happens. If you want to see what's happening or unfolding in any cultural moment, there is no surrogate.
Linda,
you're a super user of the platform. So is there a surrogate?
No, I'm an X user. I have been for quite some time. I hear what you're working on. I hear the growth rates, and you're telling me about the business. Do you envision a day that X is a public company again? You have a great story to tell.
Working at X for a little over 2 years, nothing's ever off the table, and really, the mindset of what's possible is always encouraged.
Lastly, on a personal note, I've talked to a couple executives here that know you, and they've told me privately that they say, I don't know how Linda does that job. She's working her ass off, but wow, that's a tough gig. How do you do it, Linda? From the tweets, of course we saw Elon's dust up with the president, we saw the restructurings you're working on, the turnaround. How do you handle it all?
It's been a little over 2 years, and I approach the job every day with the same amount of enthusiasm and drive that I did on day one, right? When you get the opportunity at this point in anyone's career, right? So I had a really terrific job at Comcast NBCU. But when you get the opportunity to take your business experience and combine it with a mission-driven role, which was protecting free speech around the world to help ensure and wrap a safety blanket around free speech, which leads to the success of democracy, who wouldn't want to take that opportunity of a lifetime? So you mention all of those other things. Those other things that you mention is real life and living out loud on the platform. That's why the platform has become so consequential. So when I think about what has driven me the most, it's been the vision of that innovation unfolding, and that's happened. But transformation, addressing skeptics, that's not easy for anybody, but let me tell you something. The byproduct, where we are now, is the most rewarding thing that anyone could ever experience in their lifetime, because the historic turnaround has been just an incredibly joyful thing to an experience, and an incredible outcome to our team at X. Imagine the day-to-day jobs, putting the noise out, keeping your head down, doing the work, and now what's been happening under everybody's nose, now they're starting to see it. Oh my God, they meant what they said. and they came and delivered the Everything app. So that's what's been so fulfilling, and I'm happy for the team.
So you would do it all over again?
In a minute.
Shares of home builder Lennar, they are on the move to the upside right now by about 2.4% after the company's third quarter new orders and delivery outlook fell short of expectations. The weaker forecast, it comes after a mixed quarter for the home builder. Our next guest has a neutral rating on the stock. Jay McCandless, Wedbush Securities Managing Director of Equity Research, and still with me here in studio, we've got Peter Scher, who is of Academy Securities as well here with us for the conversation. So let's dive in. And Jay, want to begin with you here, just thinking through some of the guidance and why we're still seeing the reaction that we are in the stock moving higher here on the day.
Sure. Thanks for having me on. I think the important thing, their gross margin guide for 3Q basically says that gross margins are going to be flat with where the level was in the second quarter. We think that was probably better than feared, especially among the buy side numbers. So we'll see what they have to say on the call in a few minutes. But with mortgage rates not helping the group out at this point, I think the builders are having to lean in extra hard on the mortgage rate buy downs, on the incentives to get traffic across the transom to look at homes at this point.
And so just to follow up on this for a hot second here, because one huge thing that we've seen within the home builder sector is the rate of these buy downs being implemented to spur demand. What's the read through as it pertains to Lennar and how that could be extrapolated and applied to some of the other major home builders here in the U.S.?
Yep, sure. So last quarter, Lennar talked about incentives on the average house, I think at roughly 12 or 13%. Versus normally being about 5%. And so if you think about some of the smaller cap names like Meritage, that LGI that sell to that same entry level buyer, it's a pretty big hit on their gross margins to be able to be competitive with what Lennar and some of the other builders can do. I think also with traffic, and we just got the NAHB sentiment numbers out. It's not a number we forecast, but if you look at the traffic component of that index, it's the lowest we've seen in a couple of years. So it seems like confidence, as well as just the volume of people coming out to the neighborhoods, has dropped off pretty dramatically.
Yeah, so let's put some numbers on that. And I want to bring back in Peter Scher, who's here with me on set. Builder confidence in the market for newly built single-family homes, 32 in June, down 2 points from May. And to your point as well, Jay, this coming in at near pandemic levels here. And so as we're continuing to monitor that, Peter, I wonder what we're going to continue or what you're anticipating to see play out within the home builders' sentiment as they're trying to engage with consumers right now who are trying to get in regardless and amid an environment where mortgage rates are still lower year over year but stubbornly high.
I think it's going to be a little bit weak, and part of this goes back. I used to trade the high-yield home builders, and I think it was told us one point, and it's kind of stuck with me for the last 20 some odd years. I don't think it's changed much. Home builders do really well when people are moving to new areas, right? So if you're picking a new area of the country that people are moving to, there's lots of good land. You can build a nice house that people want. And so I think you saw that maybe when we were having the fracking, right? You had Minneapolis, you had those places. During COVID, all of a sudden you had the Southeast explode, you had Florida explode, you had Texas explode. Those markets now have a lot of homes for sale. So I think that's the problem, is where are they going to have properties that they can build nice new homes that are close to the center of town? And I think people are just pulling away right now. The market's a little bit of disarray. I think a lot of people bought, the Airbnb type rentals, things that they were expecting to rent. So I expect slowness in the housing market until we either see some new trend where people really want to move to a new region or rates come down a lot.
Jay, as we think through some of the data that specifically gave us a reveal on the number of builders cutting prices in June, it says that according to the survey, 37% of builders reported cutting prices in June, highest percentage since NAHB began tracking this figure on a monthly basis in 2022 here. Is it possible that home builders can continue to cut prices knowing that on the other side, they're navigating through what some of the input costs related to tariffs are going to mean to their margins?
Yep. Yeah, I think they're going to have to. We talk in numerous reports about how high the inventories are of new homes for sale right now. We're starting to see resale inventory pick up. Resales have always been the biggest competitor for the home builders. So if we don't get any help on rates and continue to see high levels of inventory yet, it wouldn't surprise me. We have to see more price cuts, more gross margin pressure for the group through the balance of the year.
And just lastly here, Peter, I wonder, one of the major issues of the recent weeks here that we've been watching play out is specifically around the enforcement and the crackdown on immigration and how much that is anticipated and had been anticipated to impact some of the major construction facilities and operations. Are we seeing that also lead to cracks in the home builder operations right now?
Yeah, and I think this would tie back to my overall macro view is that there's so much uncertainty out there that everyone, whether it's a corporation or an individual, no matter what you think your current state of your economic outlook is, you have to behave a little bit more conservatively because you just don't know what's going to be. So I think it slows down everything, right? If I was thinking about buying a car, if I was thinking about buying a house, maybe I want to make sure that my job is still in place or that my family's job is still in place. So I think everyone's behaving a little bit more conservatively, which is why I'm so negative on the economy. I think the Fed's going to have to cut to spur some activity because I think too many people are behaving like me, which might be the right thing for me individually, for you individually, for our guests individually, but collectively it's bad.
Okay, so you've got that speedboat just waiting in the cart right now, but not hitting by just yet here. Jay, thank you so much for taking the time, breaking down the results from Lennar as well as the look across home builders more broadly. And Peter, stay with me. We've got much more to discuss. Thank you. Coming up, retail sales disappoint, what that means for U.S. consumers. That's next on Catalyst. U.S. retail sales fell nearly a full percentage point in May, more than the 0.6% that was expected. Does that suggest U.S. consumers are tapped out or an expected outcome after tariff fears drove panic spending? Joining me now, we've got Deborah Weinswig, who is the Coresight Research founder and CEO. Still with me here as well, we've got Peter Chur of Academy Securities. Deborah, good to see you back here with us this morning. First, just want to get your read in on the retail sales data that came across and where ultimately this kind of mirrors with the anticipations going into the report, given what we know about consumers and the propensity to spend, given some of the uncertainty we've been wading through.
Well, first, thanks for having me. And it's really interesting. We've been doing weekly surveys of the consumer since January of 2020, and the data literally haven't even published it yet. So in the 100,000 plus household income, we saw a 6.3% increase in terms of how they feel since the beginning of the year. But this is the clincher. The greatest negative number in kind of middle income, 50,000 and 100,000, a 12.7% drop. And then under 50,000, a 5.4% drop. So really that middle class is, I would say, even if they're not necessarily feeling it in their wallets yet, they are definitely reining it in on spending.
How, Peter, do we get to a point where some of this data doesn't scream stagflation?
Well, it's been amazing, and it's too early maybe to discount the retailer because I think we've run out of adjectives to describe, how the consumer keeps coming back. But I do think it's really interesting, I guess, makes the point that, this is the middle class, and I think that follows back up to what we were just discussing. Yeah. People have to be a little bit cautious. I don't know how student loan payments, being reported now come back into this. So I feel everyone's fairly susceptible, and whether it's hit you or not, I think everyone's behaving a little bit, more cautiously. So we need to get that going, or I think we do see the retail pull back. I don't know where buy now, pay later stands in some of this. Again, so some of these things don't show up in the credit metrics. I think the consumer's fairly stretched. And if I'm right about the jobs number, one of my big points has been that the jobs has been overstated when I look at the birth-death model. That gets a bit wonky. Right. But separately, I look at law school applications, MBA applications. They're both skyrocketing. That's, I think, what people do when they don't find a good job as they're graduating. They're like, might as well apply to law school. So I think the economy is much weaker, and maybe this is the first signs that it's going to hit the consumption. So,
Deborah, as you were talking about kind of that bifurcation that we're seeing among income classes, I wonder as well where you anticipate across the retail environment, specific names will bear the most impact, either to the upside or the downside. We got about 45 seconds.
So I think it's interesting, right? We're seeing Amazon extend Prime Day. We're seeing kind of Walmart lean into more alternative revenue streams. I still worry a lot about Target and some of the dollar stores because Walmart is now capturing that 100,000 household income plus. Concerned about the department stores, and we are seeing strength in luxury and some of these direct-to-consumer luxury brands that are new and kind of like only on TikTok, but that's been a really interesting area of growth as well.
Yeah, they've popped up in my feed pretty much everywhere here, so it's working, whatever they're doing, and it's got me to buy a couple times. I've bit the bait. Deborah, thanks so much for taking the time here with us today. Good to see you.
Thanks as always. Take care.
And a big thank you to Peter Chur of Academy Securities. Great to have some of these conversations very timely here with you over the course of the hour.
Thanks a lot for having me. It was fun.
Certainly. Coming up, everyone, wealth dedicated to all of your personal finance needs. Alexandra Canal has you for the next hour. Stay tuned.